Well, there has been kind of chaos going on in the world right now. On top of the Russia and Ukraine war, now we have got Israel and Palestinians in the war. And the world is kind of getting pretty much into the tense environment. And that is fueling the crude price. The crude price is actually fueling the inflation, which in turn is putting upward pressure on the interest rate, guys. So it's been a big dilemma for investors like you and me where to park our money, where to find a safer haven, especially when we are talking about the stocks or the property. Hello, everybody, and once again, welcome to Sinhanomics. Well, you heard that, understood that right. I'm going to talk a little bit about where to park the money and do some comparative analysis of the multiple stock markets from the return perspective for the last 10 years. As I rightly mentioned, there has been big hue and cry in the whole world. The world is slowing down. There is a recession risk in many of the countries. Many countries are already in recession, like Germany, etc. And some of them, like US, are pretty much forecasted to be in recession in the next 5 to 6 months' time. Many of the gurus are talking about the soft landing, but as the interest rate has been going up, and even now, Jeremy Powell is not phasing out the possibility of increasing the interest rate further. And that's going to create a big challenge in the market. And that's where you're seeing that after hitting the record high in something like August, the market has been cooling off. Well, guys, let's analyze the world market and based on the return. And in order to have a dollar to dollar comparison, apple to apple comparison, we will look at the return from the dollar terms. So when we look at the 10-year annualized return in US dollar terms for the last 10 years, these are the rankings. Number 1, USA, 11.7% annualized return. Number 2 is Taiwan, 8.7% annualized return. And number 3 is India. Yes, you heard that right. India at 8.4% annualized interest. And if you look at the two gaps here between India and Taiwan, it's pretty close. Number 4 is Switzerland at 7.5%. Number 5 is Japan at 6.6% annualized return. Number 7 is actually, number 5 is France. That's at 5.9%. Number 7 is China at 5.0%. And number 8 is Australia at 4.7% return. Well, now if you analyze that, the top one is USA, 11.7, and the second one is Taiwan, and third is India. Having said that, Taiwan may not be a great place to invest, guys, because of the challenges it's facing with China. And now the whole world is moving out of China and out of Taiwan. So that very much leaves India at the second spot other than USA. And when you look at the future growth opportunity, India has a much higher growth opportunity than USA. And that is very significantly visible from its growth rate perspective. When US is expected to grow at 1 to 2%, India is growing and expected to grow at 7 to 9% in the next 5 years. So that means the stock market will grow pretty much in that ratio, and you will have much better return in US dollar terms, even though there will be slight erosion from the foreign exchange perspective. Every year, if you compare that Indian rupees with the US dollar, there is slight erosion, 2 to 2.5%. Having said that, is getting stabilized now based on the Reserve Bank of India's efforts. Well, if you also look at the foreign investment in India, Actually, right now there are $0.6 trillion invested in Indian market from the foreign institutions. That's still quite low as compared to China, which has $3.5 trillion foreign investment. Having said that, the foreigners are pulling out. The financial institutions, the foreign financial institutions, FIIs, they have been pulling out from China because of the obvious reasons. We all know that. And the only destination left now in the Asian economy or the emerging markets is India. So you're going to see heavy influx of the fund to India in the next 5 to 10 years time. Again, India is going through a rapid change. If you look at the people with total taxable income of 1 crore, which is something like $10 million, or 10 million rupees rather, has been doubled in the last 5 years. From 2019 to 2023, Indians who have been filing tax with a taxable income of 1 crore rupees, that is 10 million rupees, has doubled. If you look at Nifty, which is the major index of India, Nifty 50, that has given a whopping return of 1,225% in the last 20 years. Yes, you heard that right. When you look at from 2003 to 2023, in the last 20 years, the Nifty return has been 1225%, guys. One of the highest return in the whole world. If you look at from the infrastructure perspective, the highways have grown 3x in 13 years. Airline connectivity has grown 5x in last 10 years. Broadband has gone up 70x in the last 10 years. And the bank accounts have actually grown 3x in the last 10 years. So when you look at the massive change India is going through from the economic perspective, it's huge. And that's actually opening up or creating a good opportunity for investors to invest in India. Again, when you look at the overall gross domestic product, GDP, India has taken 75 years to reach to a $4 trillion economy. So 2023, the economy is $4 trillion. It took 75 years for India to reach to that level. The next 7 years, by 2030, it's going to go to $8 trillion. And later on in the next 5 years, by 2035, it will be at $16 trillion, guys, where China is right now. So India will take another 12 years to reach where China is right now, because China is kind of decelerating. If you look at from the per capita income perspective of India, right now is pretty much at US dollar 2,500, pretty small. But with the rapid growth there, by 2030 it will be something like 5,200 US dollar, and by 2035 it will be around 10,000 US dollar, guys. That will be still not very comparable, because when you look at that from the world perspective, the per capita income of US is 70K, Australia is 61K, UK is 49K, and China is actually 19K. Yes, China is at $19,000 right now. And India is expected, it can be higher, but based on the 7 to 9% growth rate of the GDP, is expected to have around $10,000 by 2035. Having said that, when you compare the changes the countries have gone through, when they have gone from 2,000 to 10,000 range, there has been huge opportunities out there. What happened in China in the last 20 years, or what happened to US in the last 40 years, is going to happen to India in the next 10 to 15 years. So if you are a keen investor, don't miss this opportunity. You can invest directly in India, or you can invest through the ETFs, or you can invest through the stocks listed in NASDAQ or American Stock Exchange. ETF nowadays is a great investment opportunity. Anyway, let's look at some other stuffs as well, because China, as I talked about it, China is pretty much in the deceleration phase, because everybody, the whole world is looking at China plus one factor. After the COVID and the challenges they are facing right now, China used to be the factory of the world, but now with all those challenges, the world has taken a lesson and they are just pulling out of China. And that has created China plus one factor. So if you pull out from China, the obvious country is India or Vietnam. Having said that, the political status as well as the educational status of the Vietnamese, their English speaking capabilities and their skill level is much lower than India. So India has become really the next spot for manufacturing, and that's what you are seeing. Many companies like Apple and now Tesla and many other companies are setting up their factories in India. Another important thing I'd like to highlight is the Indian government has been pretty keen to push the economy. So from the corporate tax perspective, there has been a major breakthrough. Now the corporate tax of India is at 22%. Yes, it's 22%, you heard that right. And as you compare that with other countries, China is 25%, Japan is still 23%, Taiwan is at 20%, and Singapore, of course, is the lowest tax jurisdiction country. There the corporate tax is 17%, 17%. But hey, between 17 and 22, I think India has drastically dropped the corporate tax to attract the foreign investment. And the most important thing is that from the demography perspective, the demography is really in the positive side of India. 65% of the Indians are below 35 years of age. And when you look at the family size, out of the 300 million families today, 60 million families are in the middle class. Middle class is higher than the poor, but not very affluent. So they are in the middle range. The fact of the matter is that by 2032, according to Morgan Stanley's recent report, 160 million families will be in the middle class. So guys, in the next 7 to 8 years' time, there will be 100 million Indian families moving from the lower poor class to the middle class. And when that happens, what happens in the market? There's a huge consumption boom. Not in the consumer, not in the staples, consumer staples, but in the consumer durables and in a lot of other things as well. So huge opportunity coming up in India from the investment perspective. I have talked about the different types of companies in India, and I'll just like to paraphrase that again here, because if you look at India, there are 6,500, almost 7,000 companies listed, guys. Almost every sector has manufacturing capabilities. Having said that, SEBI, which is the Securities Exchange Board of India, pretty much like a government body to govern all these financial markets, just like Securities Exchange Commission, Australian Securities Exchange Commission here, or US SEC, India has SEBI. SEBI has characterized all these companies into three: large cap, mid cap, and the small cap. From the market cap perspective, from number 1 to number 100 are the large cap. So the first 100 companies or the top 100 companies are large cap. 101 to 200 are actually, in fact, 101 to 250 are mid cap, and 251 onwards, 251 through 7,000, they are all small caps. I will repeat that. according to the SEBI classification, the top 100 companies are large cap companies, the next 150 companies are mid cap, and all the other companies from 251 rank onwards are small cap companies. Their market capitalization is smaller. If you look at from the market cap perspective, the large caps are pretty much the companies whose market cap is greater than 20,000 crores. In US dollar terms, that's $25 billion. For the companies whose market cap is higher than $25 billion, they are large cap companies. The companies whose market cap is between 5,000 to 20,000 crores, or from 6 to $25 billion, they are mid cap companies. And all the other companies whose market cap is less than 5,000 crores or $6 billion and below are small cap companies. And of course, other than that, there are some penny stocks, right, where you can see 50 paise or 1 rupees or 10 rupees and all those. We are not talking about it. For an investment perspective, and especially for the new investors, you shouldn't be looking at even the small caps or the mid caps and all those. Or you can look at mid caps, but not in the small caps. Those are the most risky investment in any country. My personal advice is that, or recommendation is that if you are investing or you're a new investor, you should stay in the first 100 or first 50 or even first 20, the top 20 companies. And once you gain the experience and the knowledge, then you can explore other smaller companies which can give higher returns, but at the same time, they're very, very risky. They can actually drop like a fly. Well, if you have to invest in India, as I told you, the best thing for those guys who are not in India, the best thing would be to start with the ETF, exchange traded funds, or the index funds. Or if you are able to invest in India directly, then you should stay with the top companies. In one of my previous videos, actually, I talked about the Navratnas, the nine key, very vital companies. I'll just repeat them for here. So in my personal opinion, and I might be holding stocks in that, so that's my disclaimer. But from any angle and all the angles that we talked about it, the top companies to invest in India, and they're all part of the Nifty 50 and the top 20 companies, are Bajaj Finance, Bajaj Finserv, HDFC Bank, Nestle, Britannia, Avenue Supermart, which is also called D-Mart, and in the IT, it's Tata Elxsi, or LTI Mindtree, that is the Larsen and Toubro Information and Mindtree company, or its another replica is also KPIT. But anyway, not to confuse you, Tata Elxsi is the best company, and I have covered that in one of my videos. I recommend you to go and have a look at them. Other than that, because as I talked about, that 100 million families will be moving to the middle class, and that will actually give rise to a huge opportunity in the automobile sector. Maruti, which owns 50+% of the cars market share today, is another one. And on top of that, Escorts Kubota. So Escorts actually has multiple automobiles in the two-wheeler and the four-wheeler space. It also manufactures tractors for the agricultural India. That's another one. Tata Motors, which is a automobile company of Tata's, they are pretty much leading the pack in the EVs, electric vehicle space. These are the companies, pick any of those from the automobile side. And then you have Titan, which is not only a watch company, now it's also jewelry. They're expanding into the fabrics, etc. And last but not the least, Asian Paint. All these companies are the top companies, and if you look at their historical chart, guys, you will understand that. Or you look at their ratios, price earning ratio, price to book ratio, EV to EBITDA ratio, debt equity ratio, any of those. So these are the top companies you should be investing, or you should be investigating, researching before investing in India. Having said that, I like to reiterate, these are my personal opinions, and as I told you, I might have stake in many of them, I might have investment in those companies. So that's my disclaimer. Take it with a pinch of salt. At the same time, don't forget to consult your financial advisor before making any investment decisions. Sinanomics is out there to create financial awareness so that you can understand the market, analyze the companies, and then invest and make money. If you like this kind of contents, don't forget to like, share, and subscribe. I'll come back again with another interesting video for you. Till then, it's a goodbye from your finance coach, Pankaj Sinha. Bye-bye.